the technology issue. Hopefully this is now working. I won't be able to see the YouTube chat. So anybody that is on the YouTube chat, maybe find us on Facebook. We'll be live on Facebook. You can ask questions there, or you can email us with questions, which is becky@traddictiv.com. So you can check that out. I'm going to open up the Facebook one so that anyone that has questions with that can ask us there. So anyone that's on YouTube right now, head over to Facebook and I'll be able to see any questions that you guys have there. So just let me know on that chat box. Otherwise, those of you that are within the closed room, I'll see you on the chat box there as well. So by all means, ask questions there. Now, I'm just going to repeat. I know I've already just done this and then I got cut off, but I'm just going to repeat what I was going over in the first place. If I can just make sure I get up everything. There we go. I'll just repeat what I was going over very quickly. I'm just going to put the disclaimers up here. There you go. It should be being highlighted there. There you go. So disclaimers, just understand we're doing demonstrations of how we do things. It's up to you how you take it, if you ignore it, if you do it, if you do something in between. Any questions that come after the fact, if you're watching this recorded, then by all means send me an email, becky@traddictiv.com, or go to tradewithufos.com/Becky, get yourself a free Trade with UFOs membership, and then you can ask me publicly. Okay, so just to explain how we do things, I've obviously already said hello twice now, and just to explain, we are simulcasting. So I was having the technology problem. We are streaming in many places, and then if we get a little bit of an internet dip, which is unfortunately what happened, it would cut off the stream. So we're simulcasting now on YouTube, although I can't see the chat box. We're simulcasting on Facebook in our live closed environment as well. So it means that people are watching it from different places. Of course, the people that are in the live closed environment, these are people that are paying for coaching, which means they get more of our time. So we offer these kind of sessions for free, of course, on YouTube, so that people that are using the apps or people that are just learning and people that are wanting to understand how we do things can, of course, access that, and there's no barrier to that. But the sort of flip side of it is that those that pay for the extra time get the extra time. So what happens is somewhere in the middle of the stream, we'll cut the stream to those free live channels, so to Facebook and to YouTube. What we aim to do when we are trading in live markets, which is what we're doing today, what we're going to aim to do is at least place one trade for those that are watching for free. So you understand the methodology and how we explain things. You also understand an application of it. And then we'll look for further opportunities in that second bit. In terms of when that is, in terms of timing, obviously it changes depending on how many opportunities we see or not. If I don't see any opportunities, then we won't cut off at all. If I see many, then it might be that we cut off earlier on, but we'll see how we go there with that. So what we do is we're going to understand the market environment, review closed trades, look for any open trades that are open, how we manage them, and look for new opportunities as well. So hopefully it makes sense how we do this and how it's going to work. And again, any questions, come to us on Facebook, and I'll be able to see the questions in the chat box, or if you're within the closed community, I'll see that there as well. Okay, so let's get started. First things first, let's have a look at what happened last time. So last time we had a look at various I think we had two opportunities last time, one live and one in the closed group. The first one that we looked at was Beidou, I think that's how you say it. Again, you guys will notice that sometimes I don't even know how to pronounce the names of the stocks that we look at. Not important. What is important is how we trade it, why we traded it, the technology, the statistics surrounding it. So this one was a decent opportunity. The next one we look at, I believe, was a losing opportunity. So if you took both, you had one winner, one loser. If you took one of them, hopefully you took this one and you were on the winning side of this. So we had, at the point where we placed this trade, it was the 19th of March. I'm just going to freeze that here. 19th of March was when we placed the trade. At this point, we were on the first of what would be a usual move of 6-7 candles to the downside at the time. We were on the first of those candles with probability to the downside using our auto climate. By the way, if you are very new to this and you have no idea what I'm talking about, don't worry. When we look at new opportunities, I'll explain what this is and what that means. So for those of you that were on the session last time, we had the first of what would be normally a few candles to the downside, and we had probability to the downside. We found a UFO that this represents and that this represents here. We found a UFO that gave us our entry. Our entry price was this black line. It was 265.11. Our stop price was this red line, and it was 271.85. So that was on the 19th of March, which was at this point. Now, since then, what happened? If we just get rid of a few of those arrows there. So we put the trade on around about this point. Price came back in, hit our entry at this point, moved away, hit our safety target, came back, didn't quite hit our entry again, and then moved away and hit our final target. Now, our final target would have hit around about the 20-something of March, 26th maybe of March, around about this point, which was, I guess, around about here. So we still would have had probability to the downside, wouldn't have cancelled it in the meantime. This is an example of one of those trades that just works out exactly the way we want it to work out. We didn't only hit our safety target, we didn't even need to manage this. We just went straight down and hit our final target. Happy days. Would have been roughly, just by looking, I would have had the notes here somewhere, but roughly just by looking, it would have been overall maybe 4 to 1-ish, maybe 3 to 1-ish overall, by taking half of our position early and half of our position later on the final target. So great, this was a brilliant trade that happened. We're happy with that. And again, no management would have been needed, although you could have followed price, followed the UFOs, and dragged your stop loss that would have been originally here. Let's say a new UFO formed here, you put your stop loss there, new UFO forms here, stop loss there, new UFO forms here, stop loss there, and so on. You could have done that to lock in profit along the way, but in this case, in the end, we can look back and say that wasn't even necessary. So nice one there. Now, the next one that we looked at last time was NVIDIA, I believe. Let's see if we've got a drawing. Here we do. And this one didn't work out. And again, it's just the nature of trading. Sometimes we have trades that work out well, and sometimes we have trades that don't work out very well. It's all about probabilities. What we lose when we're wrong, what we make when we're right, how often we're right, how often we're wrong. In this case, it was 2 trades, so it's kind of 50-50, very small data sample here. And what we won on the one that we were right on would have been a 3-4-ish to 1 if you balance it out. And on this one, we would have lost just 1. So even though one was right and one was wrong, overall it would have been an overall profit from those 2 trades. So with this one, we put the trade on again. It was the 19th of March. So we put the trade on around about here. We had a safety target. In fact, if I squidge this, then we'll see our final target as well. We had a safety target here. Final target here. Our entry was the black line at 518.50, and our stop loss was the red line at 525.37. And as we see, price just went straight through it. Didn't even give us a chance. We didn't even hit our safety target. Just went straight through and we would have just lost that. So again, no management needed. It triggered, by the looks of it, it triggered on the 22nd of March, which if that's the 19th. 22nd of March, there you go, is still a thick red dot, so it would still have been probability to the downside. We wouldn't have cancelled the trade by the time it triggered. At the time when we got in, or the time when we put the trade on, it would have been the candle before that. So we still had everything going in our favor with climate. It just didn't work out. That happens. So again, no management would have been needed with this trade. We would have just taken a stop out relatively quickly. No worries, we won on the other one. Overall, no problem. So those are the sort of analysis or summary of what happened last time, of the trades we put on last time. Again, I think I actually really like that we have those 2 that just happened to be that way. We had one that did everything we wanted to do and one that went completely against us, nothing in between. Those are maybe the cleanest ways that we have our trades, right? We either hit our final target, we don't even look at it, great, we've made money, or we get stopped out and fine, we lose money, didn't need to look at it, no management in between. Most of the time, there's going to be some form of something we need to do. Whether or not we close out the position early because the market conditions have changed, maybe we trail our stop loss to lock in profits, maybe we move targets based on new UFOs or new movements. In these 2 cases, they were very clean and either side of the extremes, and obviously understand there could be things that happen in between as well. But again, any questions on that, you guys let me know. Okay, so I'm just going to delete this off the screen here because it's now no longer relevant. We already had these trades, we've already closed them, so happy days. So now what we're going to do is firstly just come to the economic calendar of FX Street. We're going to filter by high impact news and the United States. The reason we do that is because we're looking at US based stocks, which means we want to know, is there high impact news coming out on US markets? Now, what I'm looking at here is everything coming up to next Tuesday. I can change this and decide how far in advance I want to look. So we could go from today till next Friday, for example, and apply. And then we see what's coming up the next week or so. I tend to look at swing trading type timeframes, the same logic, the same methodology, the same technology applies to bigger timeframes investing or smaller timeframes day trading. But for me, the next week or so is important to understand. Again, it's not necessarily something that's going to make me not trade. It just might make me be a little bit more aware. So we have high impact news coming out next week on US markets on Tuesday, Thursday, and Friday. So again, we might just be aware of that. And on those days before the market opens or just before these news statements come out, we might look at the market conditions and see if we want to take off a percentage of our position to protect ourselves against that volatility, whether or not we want to move stops and lock in a bit more profit, whether or not we want to close positions entirely. How you react to that high impact news and volatility ultimately is up to you as an individual trader, how you feel about individual risk tolerance and things like that. I'm just going to unplug something here so I get a bit more space. There we go. So yeah, the impact that we have there on high volatility could impact the markets, could not, depends how you see it. Just take a look and then you can interpret it as it fits with your trade plan. Okay, so now let's look for new opportunities. So we now are coming to TradeStation. By the way, I know some of you guys will use TradeStation, some of you will use TradingView, some of you will use different platforms. The apps that we use are available on TradeStation and TradingView, so that's why we use that. But you can execute through anyone, pretty much. As long as you can put the trades in and put the numbers in, you can execute through a different broker. You don't have to use these brokers. You don't have to use these platforms. You might just use these platforms to help you with the apps and then go and execute somewhere else. So no bias really when it comes to things like that. Now, first things first, what I always want to look at first is what is the general US market doing? We're going to be looking at, in general, US stocks, right? Individual US stocks. And I'll talk in a minute about the scans that we use in order to filter down from the thousands of US stocks that we could choose from, which ones we're going to actually look at. But first things first, let's understand what the general US market is doing. Now, this isn't a has to be, this is a helpful addition. Because if the market as a whole, let's say the market as a whole is going up, market as a whole has probability to the upside. And then we look at a US stock that's going down and has probability to the downside, it may be that it gets swept up with what the rest of the US market is doing and it pulls it up. So even though it has probability to the downside individually, in the context of the greater market, we don't have as many probabilities. Ultimately, the apps tell us where we have probabilities and what we need to do with them. So even if it's going against the grain, I'd still place that trade, but I would rather look at opportunities first and foremost that do follow the grain, that are involved with what the rest of the market's doing. It adds correlation in my favor. It's an extra variable that puts probability on my side. Again, not definitely necessary, just a helpful addition. So it's the first thing I tend to do, kind of makes it a little bit more logical, I guess, and efficient what I'm about to do by looking at the individual opportunities. So first things first, we're going to come over here and we're going to check what is going on the daily chart in terms of probabilities. At the moment, we have a thick blue dot on the daily chart of the S&P, which tells us we have probability to the upside overall in the US stock market. So that means I'm going to firstly look at opportunities that have probability to the upside, because I already know I have at least correlation on my side. It's not to say I'm just going to go and place buy on all of these trades. I'm going to look at them individually, but overall probability to the upside there with the market as a whole. So I'm going to look for individual stocks that also have probability to the upside. Now, what we've done here is we have these little scans. By the way, if you're watching this live or recorded and you fancy having these scans to have in your trade station, just email us to support@traddictiv.com, or you can email me, Becky@traddictiv.com, and we'll send them to you. Essentially what these scans are doing is looking through the timeframes and the markets, telling us where we have probability to the upside based on climate information and also based on options information. So that comes back and it tells us, out of the thousands of trades we could look at, here's 5 that have probability to the upside enough for you to even look at. Doesn't mean we're going to place trades on all of them. Exactly later on, but let's have a look. So we use this scan and I'm just going to click on that top stock, and that's now opened up the chart of that particular stock. Now the time frames I'm using, by the way, just wait for that to load. Time frames I'm using are a daily chart and a 55-minute chart. So daily chart for where do I have probabilities, and 55-minute chart for where am I actually going to place these trades. Now, strangely, perhaps I didn't run that thing. Let's just click on the next one. So strangely, that didn't quite sync up there. Let's have a look at this one. There you go. Okay, so this one, so Z-Lab or Z-Lab, depends where you are in the world as to how you would pronounce that. Zylab, I guess is the name of the actual company. Again, I know it might sound really strange that I to place trades on and I don't even know what they are. Those of you that trade using fundamental information might find that a little bit mind-boggling. To me, I prefer it that way, and it's just my personal approach. I don't want to know really about what's going on in the stocks, what's going on in those companies, because it's subjective information that I have to interpret against other subjective information and other people's opinions and other things that I could research that could confuse me and overwhelm me. I'd rather just use the technology, and the technology saying, this is where we have probabilities, this is where we'd be likely to get in, and then I can kind of make a decision from that. Based on objective fact, I don't even need to double guess it. It gives me the answer based on an objective methodology. You might layer fundamentals into that as well to give you correlations. You might think that the way we do things doesn't work at all and you just do fundamentals. Fine. If it ain't broke, don't fix it. If what's working for you, keep doing it. But at least this is the way we think about things, being more objective when it comes to using technology. So first things first. Before we do anything when we trade, we need to be coming and looking at where we have probabilities, up or down or nowhere. So we already looked through the scan to look for stocks that have probability to the upside at the moment. But what we want to know first and foremost before we do anything, and answer this question however you will, for us we do this with AutoClimate. Should I buy, sell, or do nothing? And doing nothing is a perfectly valid answer. No point placing a trade for the sake of filling time or for the sake of placing a trade if it doesn't have probabilities on your side. That's not very helpful. So if we're going to understand whether we buy, sell, or do nothing, how do we answer that question? For us, it's AutoClimate. It's this over here. You might notice on AutoClimate, we have little dots. We have red dots, we have blue dots, and we have dots that are so thin you can barely see them. The thin dots are telling us not enough probability, leave it alone. Look at something else. Change time frame, change market. The thick red dots tell us probability to the downside, look to sell. The thick blue dots tell us probability to the upside, look to buy. So we always look at the furthest right, the last dot that we have. In this case, the furthest right is a thick blue dot, probability to the upside, which means look to buy. Doesn't mean buy, it means look to buy, because there are other things that also need to line up. We need enough variables on our side here. So if we've decided we're going to buy, what next? Where do we buy, and exactly how are we going to do that? So this is where we answer question number 2, which is, if I buy, where? If I sell, where? Where am I going to do that? If I just click buy whatever the price is right now, that's extremely subjective and extremely random. It's whatever the price happens to be when you sit looking at it. What's the likelihood that that's the price where price is going to turn and go up from there? We want to get in where we have lower risk, higher reward, and higher probability. That's where these babies come in, our AutoUFOs. AutoUFOs, again, are an app that you can use. Depends on which platform you use as to how much they cost. AutoClimate, by the way, is a free app. AutoUFOs is a paid-for app, so it's either $89 a month in TradeStation or $34 a month in TradingView. Obviously, slightly different functionality there, but they're highlighting the same thing. With the AutoUFOs, they are highlighting for us where we have stacks of buy orders and stacks of sell orders. Why is that important? Why would we care for that? Because if you're going to buy, better to buy with a big stack of buy orders, because a big stack of buy orders is likely to beat the sell orders and push price up. The price goes up. If you're going to sell, you want to sell where there's a big stack of sell orders, because the bigger the stack of sell orders, the more likely it is to beat the buy orders and push price down. So we want to be involved at that point. So for us, we are using an app that's showing us and giving us the prices between these two numbers is where we have big stacks of buy orders in this case. So yes, great. We've decided that we're going to use our UFOs. And if I switch this down, you might see more. Maybe I'm not loading enough data there. We're seeing 2 UFOs. How do we know which one to pick? How do we know if we should take any of them? Sometimes you'll see loads and loads of UFOs on a chart. How do you know which one to place? There's loads of stacks of orders. Which one's going to be the best one? Which one has the highest probability? This is where we layer in a third element, which is our EMA value. Now, by the looks of it, it doesn't look like it's quite gonna add up here, but let's have a look. Our EMA value, it's kind of hard to see there, but I'll type it out. The EMA value on the bigger time frame here, on the daily time frame, is 131.49, which is around about here. Okay, around about there. Why is that important? Why do we care? The EMA, which stands for exponential moving average, is a very, very commonly used indicator that retail traders use and that hedge fund managers use to help them enter positions. Theory being, if the price hits the average price, then you buy. If price is below the average price and comes up and hits the average price, then you sell. It's a very simple way of doing things and perfectly valid. Again, works for some people. So why is that important? Because if we have buy orders here, for whatever reason, there's buy orders there, and it would also happen that we have the EMA inside that, then we have buy orders and extra buy orders because people are going to buy at the EMA and come in and place market orders at that point. So we have orders waiting and orders that have come in at the same price or around about the same price at the same time, which gives it more probability, more likelihood of pushing price upwards. So we want to be involved in that scenario. If we jump in at the EMA, let's draw that again and see where that would be. If we just got in at the EMA, say at that price, it has some probabilities of working, but not that many, because there are loads of reasons why people buy and sell, not just the EMA. If we got in just at the UFO, yes, there's buy orders there, and yes, that gives us probability, but not as much as if we had the EMA as well. So our methodology tells us we only place a trade when those two things line up. When we have probability to the upside or downside with our climate, and that tells us that. And if we do that, and if we've got probabilities to the up or downside, we look for opportunities that have UFOs and EMAs combined. If we don't have those things, we move on to another opportunity, which in this case, we move on to another opportunity. It doesn't quite line up. This UFO here, the starting price, if I just show you that, let's just do that again. The starting price is 129.66. The EMA value is 131 something, which means not lining up. So no worries, we just move on to another opportunity. We just click the next one down and we'll look at a different opportunity, a new opportunity, and see what lines up here. And again, it might not line up, and that's okay. It might line up perfectly, and that's also okay. We just want to make sure that we're only ever trading when we have probabilities on our side. If we don't have probabilities on our side, or not enough probabilities on our side, then we trade for the sake of trading, we place a trade for the sake of filling time, and it's less likely to work. So we've taken time to place a trade and lose money, or more than likely lose money. Why would we do that? We want to make sure if we're risking our money, we have probability that it's going to go in our favor. So here again, we have a new opportunity or a new stock to look at, scalar. We have a thick blue dot, probability to the upside, so that's great. We have UFOs, however, the EMA value is 179.34, which is around about here. Now, I'm gonna kind of go back on what I've just said here to talk about anticipating movements of our EMA. Now, you get used to this and you can set alerts and things like that. You'll get used to this the more you see it, the more you watch EMAs move. Now, EMA stands for exponential moving average. So it gives you the average of the last few candles. In this case, it's the last 9 candles. Gives you the average, which means as price moves, the EMA moves because it's got new data to give you a new average. So as price moves down, let's say price moves down from this UFO, our EMA, let's now say that the EMA is this red color, will also move down and may coincide to be inside this UFO at the time when price reaches it. We don't know that. It's not already there. It's not obvious to us right now, but price would have to move from where it is now 5 cents down or so, 6 cents. Oh, $6, sorry. It's got to move $6 down to get to our UFO. If price moves $6 down and our EMA is only $2, $1.50 ahead of our UFO, then as price moves $6 down, the EMA is likely to move $1 or $2 down, which is all we need it to do to coincide with that UFO. So there are two ways to do this. You can set yourself an alert, and let's use a different color here just to make the point. You can set yourself an alert to say, if price hits that line, let me know so I can check and see whether the EMA is aligned with that UFO, and then I place the trade. You can do that. That's more conservative. What you risk in that is missing the trade entirely, but what you save in that is not placing a trade that may not fit all the variables that you need. Or you can place the trade and monitor it. So we can place the trade and say, cool, that's our entry, this is our stop, maybe underneath this one, this is the trade we're going to place, and perhaps we don't get to it in time to cancel it, the EMA doesn't quite line up, and we end up in a trade we don't want to be in. So we have to manage that a little bit better. But the plus side of it is that it's likely that if price moves down, the EMA moves down, they do line up, we get in the trade, we don't miss it. Neither way is right or wrong. It's up to you guys to decide if you're more or less conservative. For me, I'm going to place this trade as an example of how we place that trade. We'll look at it next time and see whether or not we would have cancelled it. So let's take a look here at the charts on TradingView so that we can finish it off there. So it was ZS or ZS, you guys would say, in the States. So again, we're going to make sure that we see that on both time frames. We're going to look here, we have daily and we have 55, so that's great. Our EMA there was 179.31, so again, roughly around about the same place, but we're assuming that as price moves down, the EMA comes down. And this one right here, this UFO right here, is going to be where we place our trade. So let's have a look and see what we're going to do. Again, like I said, you may place an alert. This doesn't exactly line up right now. We're anticipating that it will. So again, this might be something that we cancel before it triggers, but I'm going to place this trade to show you how we do it. So first things first, what I like to do is just draw. I use my Fibonacci lines. I know that I'm not using them for what they were originally intended. I use them as a drawing tool. In fact, I'll have to do it the other way around there. I use them as a drawing tool, and I've customized it so that the black line is my entry and the red line is my stop. It just gives me reference values so that if the UFO disappears, because it stands for unfilled orders, so as the orders get filled, it can disappear. As the orders might disappear, I still have reference on the chart as to what I did, where I got in, where I got out. So what we're going to do is we're going to take the numbers given to us by the UFO. The top number there is 178.02. That's the start price where we see buy orders. And we're just going to leave it at that, 178.02. 178.02. That's our entry. Now again, you can add a couple of cents if you want to. I'm not going to in this case. And then we're going to take our stop loss value, which is given to us here, 173.53. And I'm going to take 10 cents away to just give my stop a little bit of room. So it'll be 173.43. Again, you might have different rules as to how you give yourself wiggle room. For me, it's just a basic 10 cents, makes it easy to do. Just check my battery there. Okay, so we have, I'm just going to have to plug that back in there. Otherwise, I'm going to disappear again because of my battery. If I can. There we are. Cool. So we have our entry value shown to us here, which is 178.02. And stop value there at 173.43. Great. And the UFO told us those numbers. Yes, we might add a little bit for a little bit of wiggle room, but we get the objective numbers from an objective technology that has no emotions and isn't subjective and says to us, this is where the buy orders are. So that's where we put them. Now, where are we going to put our target? So this again comes into a new layer here. Now, with what we have here, by the looks of it, we don't have sell UFOs on our bigger time frame, and that's normally where we would place our final target, where we're going to take the most out of the market. So what we'll do in this case, we'll put on a safety target, and then we'll have a trailing stop for our second one, and I'll explain how we do that. So first things first then, with the safety target, let's just bring up the order panel here. It's really easy to work this out on TradingView. So again, whether you trade with TradingView or not, or whether you attach a broker to it or not, doesn't matter. You can use it to help you with the math so that you don't have to do it. So all I've done here, I've clicked buy. I've typed in my entry price, which is 178.02, and my stop loss, which is 173.43. Those were the numbers that we added a little bit of wiggle room, but came objectively from the UFOs. Now, my safety target is always 1 to 1 away. So whatever the distance is here is going to be the same distance here for my target. And we do that for a reason. So if I click take profit, all I need to do here is telling me I'm risking $4.59. That's what I'm risking on this trade, $4.59. So all I need to do is risk the same amount. So it says here pips. So in this case, pips meaning just the smallest increment of price. I'm risking 459 cents. So I'm going to say to it, can you take my profit 459 cents above? And it's worked out what the price is. I didn't need to take the entry and subtract what the stop was, figure out what that is, and then add it to figure out what it is. TradingView did it for me, and it's told me 182.61. So what I'm going to do, I'm going to take a horizontal ray there. I'm going to just draw it on the chart randomly, double click on price, and then I can change the number to 182.61. And that is now where my entry, stop, and safety target would be. I didn't have to think about it. I didn't have to wonder about it. The numbers were given to me. I added my wiggle room, figured out what 1 to 1 is. It's all mathematical and technical. So all I'm going to do here, I'm just going to tell it overall, I want to risk 50 bucks. Overall, I'm going to have two targets or two trades that go in at the same place. Overall, it's going to be $100 risk. That's just because it's a nice round number. Just as an example, you guys can place trades that are bigger than that, smaller than that. It's going to be percentages of your account. This is just an example. So $50 on one, and then I'm going to click buy. That's now gone in. And you can see I've got my limit, my stop loss, and my take profit. Now I'm going to do the same thing again, but slightly different. So 178.02 to 173.43, $50. And in this case, I'm not going to put a profit target in. Normally, what we would do is we would take red UFOs from the bigger time frame and use that as our target. But we don't have red UFOs on the bigger time frame. So what we do in that case is we have a trailing stop situation. So this is where it requires a bit more of our management. So if I just click buy now, I have a buy limit and a stop gone in, and you see here, it's showing me my limit and my stop, but no target. On the one that I put in before, I had another box here that told me my target. So what this means now is I'm risking $100 here. If it just goes straight through, then I lose $100. If it hits this, moves up, hits my safety target, and then comes down, then I would have made $50 and then lost $50 because I'm risking $50 on each. Together they make 100. If we split them into two, so they're next to each other, making 100. First one goes 1 to 1, I make 50 bucks. There's $50 still here being risked. So I make 50, I lose 50. Overall break even. Now, what if it goes in our favor? What if price comes in and moves to the upside? Normally we have targets that we're going to get out at those specific places, but in this case we don't have one. So what our plan will be is as price moves up, if it goes in our favor, and let's say new UFOs are formed, got a new UFO there, we're going to take our stop loss and we're going to put it underneath that UFO. If price continues to move up and a new UFO is created, then we're going to take our stop loss and we're going to move it behind that UFO. So this trade will require a little bit more active management. That's a swing trade. You probably need to check in every couple of hours or so just to see if new UFOs are formed and what you do with your stop loss. But what we're doing in here is just locking in profit. As price moves in our favor, we lock in profit. So that let's say this happens and then price comes down, we get stopped out here at profit. So we made 50 bucks at this one, and then we made, I don't know, 70 bucks there. Overall, we made 120 bucks. If it just goes against us, then we never need to do that. We never need to manage it. We just got stopped out. Both of our trades hit the stop loss. We lose $50 on one, $50 on another. We've lost $100. So hopefully that makes sense as to how we put in our targets. Again, any questions, let me know. Let me just check the chat box here. I haven't looked in a while. What did you base your scan on from Paul? So we based the scan. If I show you, I'll bring it up on TradeStation here. So if I show you here, these are the kind of things that the scan is looking at. So again, we can send you the scans. You can play about with it. So we want it to be over a certain price. We want it to have over a certain amount of volume. We want it to have over a certain amount of open interest in the options side of things. You don't have to use the option side of things, by the way. You can just use it and base it on price and the amount of volume. And then we want the close to be over the moving average. So again, it's above what our potential opportunities will be. So hopefully that answers the question there as to how we use that on the scan, or why the scan is there, or what we use it for. For those of you that don't use TradeStation and you don't know how to read this, don't worry. Just understand the scan is built to look at certain criteria and come back and say, these stocks hit that criteria. The criteria is its price, how much volume is in it, different options, categories, and then whether or not it's above the moving average or below the moving average. Therefore, is it a buying or a selling opportunity, essentially? Okay, so if we come back to, let me know, Paul, if that makes sense, by the way. Sorry, it took me a while. I didn't see that there on the chat. So coming back to this, we now have this full trade that's now been put in. So as I said, we cut off the stream after we found one trade. So I'm going to cut it off here. And then those of you that are joining us in the closed room, you will be able to see this continuing as we look for another opportunity. We may find one, we may not. We come to these in real life, looking at opportunities in real time. Sometimes they appear, sometimes they don't. We'll just take a look. So we'll look at the next opportunity. But for those of you that have joined me so far on YouTube and Facebook, apologies for the little bit of delay there at the start with our tech issues. Hopefully this has helped for you guys to be able to come back and understand what we did. We looked at what we did before. We had a winning trade from last time and a losing trade from last time. Both very simple. One hit both targets nice and simply. The other one, both hit the stop nice and simply. This is an example of where we might need to manage it a little bit more depending on what happens as we get into this trade. Hopefully you understand why we place this trade. If not, just keep watching these videos. You'll get it. It will come over time. Again, AutoClimate is a free app, so you can download that for free. It helps you figure out whether or not to buy or sell. And then AutoUFOs, depending on which platform you use, is paid for, but will help you figure out where exactly to buy and sell. And then you can layer in the moving average as well, which is also a free indicator. Okay, so I'm going to stop simulcasting at the moment. And we'll carry on in the closed room. So I'm just going to turn it off now on Facebook. Give me a sec, guys, whilst I do that. And then we'll come back into the